Welcome, everybody. My name is Sara Glakas. I am one of the founders of the Austin Women's Investing Group, which is where you are right now. I know we have like a whole bunch of new people because this is the first time we've ever done this at Dress for Success Austin in this room. So thank you to Nina. I'll have her come up for making this happen. Just really quick about the Austin Women's Investing Group. First, we are completely volunteer run. And we're very loosely organized. I say that because if you want to donate to us, you can't, because we're just a volunteer run group of women who like to have these groups of women in a room to talk about money, investing, and finance. That's how it started in 2011. What year is it? 2016? How many years is that? It's a lot of years, right? So we've been doing this for a whole bunch of years. Yeah, 15. You guys, that is awesome. All right, so we used to meet in people's living rooms, with their kids and their cats and their whatever, right? And then we outgrew people's living rooms. Then we went to free coffee shops. Then people were sitting on the floor in the coffee shops. Was anyone here, Lori, were you here that year where I forgot to reserve the room at the library and we had to go next door and they were like, oh, well, we have a room that fits about 15. I'm like, I think we have 15. And we had 40, right? So, but when they were sitting on the floor and on stacks of cushions, all of that to say, this group has grown over time, just word of mouth, right? It's just women coming to the group and then bringing a friend, telling a friend, a coworker, their mom, their daughter, their, sisters, all of those things, right? So after 15 years, we are 6 people away from 3,000 members, right? We have these meetings every month on some range of topics, right? So, so here, February, we're gonna have one on divorce, right? Or getting married and getting divorced, just kind of what you need to know about that, February 14th. And in March, we have our meeting on getting retirement ready, specifically if you're 10 years or less out, right? But what I'm gonna do on social media and in our follow-up posts is ask you guys what you want to talk about for the rest of the year, right? So your organizing committee is here. There's myself, Sarah, Casey Swartz is in the back. On the organizing committee, Lori Watts is over here on the organizing committee, and Team Brown in the back on the organizing committee. We're just loosely organized, y'all. So we are here to give the people what they want, and what you guys want to see is what we want to make happen for you. Just going back, the sole mission of the Austin Women's Investing Group is to get women together in a room to talk about money, right? This is the space, whatever the questions are. There's no such thing as a dumb question. There's no question too basic. There's rarely a question too advanced, right? All of these women around you have varying levels of experience, right? Some of you are super beginners, right? And thank you for being here, right? Please ask questions as they occur to you, because there are other people in the room who have the same exact question that you do. There are people in the room who have a ton of experience, different aspects of investing, and we try to touch on the main ones, investing in stocks, investing in real estate, how to use your retirement accounts, taxes, kind of the more personal aspects of personal finance, like getting married, getting divorced, all of those things. Long story short, whatever the question is, please ask it, right? It's very, very important. Whenever I invite people to this, they're like, well, I don't have any experience. Well, that's the point, right? So please keep that in mind as we go through this. Our main home is on Meetup, and it has been since we started. That's where the formal invitations come. So you'll get an email that tells you what our topic is, the date, the time, the location. It's where we send the follow-up email. So for example, I have this whole slide deck. I'll send that out via email through Meetup. So if you're not on Meetup, you might not get those things. But if you're just not into Meetup, it's just not your jam, or if you're here through Dress for Success, you can also follow us on the socials, right? So we have a private Facebook group. We keep it private so that we can discriminate against men. So, and so we monitor who's in there. We're very discriminatory, and just to be perfectly upfront, we do have a YouTube channel. So Casey's back there trying to record this. Again, we're volunteers, guys. We can't. All right, sweet. We have we're 50-50 actually recording these. We have Instagram where we try to keep y'all apprised as best as we can without being professionals at this. So any questions on that part of the group? As those of you who are here, who've been a part of the Austin Women's Investing Group for a long time, you know that we typically start with everybody introducing themselves. But since it's such a large group, And like my toxic trait is like having too many slides in a slide deck. We're going to skip that part this time. But in other meetings, it's going to be really important because we know people who have met each other for jobs, for just like investing buddies, money buddies, sitting next to the women next to them in the room. So I'm sad that we're not going to do that today, but in the future, we'll do that. And then I do want to ask Nina, can you come up and talk about Dress for Success Austin and this amazing collaboration that we brainstormed? Oh, yeah. Oh, Nina, can you hold on? Let me actually say it into this.
I can. I love being on mic. My name is Nina Guilford. I am the programs director with Dress for Success Austin. I have been with Dress for Success for approximately 20 months. My 2 years will be first week of May. Over the last few years, we really have grown our programs and the number of women we serve. So in 2025, we've served 1,008 women. And each of those women have come back to us approximately 2.5 times statistically. So some a little less, some a little more, but it evens out 2.5 times. So there are a number of programs to participate. Dress for Success Austin is a nonprofit. I got questions this morning as you all were walking in. Can I donate? Yes, you can donate. We accept donations on the third Friday of every month here in this building. There will be signs and all kinds of things to tell you where to go as far as your donation is concerned. Some are saying, can I be a volunteer? Yes, you can be a volunteer. I put volunteer flyers on the back panel there. You can scan the QR code. I also put Haley Poorman. She is our volunteer manager. Her card is there. Take her card, email her with any questions that you have. And then I got questions about services. How do I become or participate in any of the programs? We offer career support, which is redoing your resume, interview prep, LinkedIn updates, all of those things. If you're like, hey, I'm in transition, I really don't know what to do, we have that as well. So we have a number of programs and things that we do here. I would like to put a plug in for our professional women's group. Whoop, whoop. We meet on the we meet on the last Tuesday of every month from 6 to 7:30. And that is every month. We have snacks, and not just snacks, but we have food. A lot of food that sometimes I'm like, take the food with you. But there's always people like Sara who come in and present on a topic, or we do something outside that's fun, like we had some personal defense classes. So depending on what it is all at no cost to you. So if you have questions later on, I will be here. I'll be on the back couch observing and taking in all the information as well. Thank you, Sara, for coming in. We started this partnership a few months back in 2025 with our financial wellness group. And so here at Dress for Success, we are in love with our community partners and those that are choosing to partner with us for all women's success. So Sara, thank you.
All right, and thanks to this partnership, we now have a home for 2026. So longtime members, you know that we scooch you around to all the public libraries here and there. What day? Who knows? What time? No one knows, right? So now we know that every second Saturday at 12:30, we're meeting here, right? There's parking. Oh, yes. Oh, yeah, one more plug from Nina. Did you guys, oh, get out. Hey, Carolyn. Yeah. Yeah. Yeah, there's some Chanel pumps for someone with small feet. There's some Chanel pumps in the dressing room. Yeah, yeah, yeah. And from what I understand, like the styling is not like there's no strings attached, right? So there's no income requirements. There's no restrictions. Just come in and have someone dress you, like, and then you just leave with the stuff, right? It's awesome. It's amazing, right? And so fun. So like the more that people, the more the community use all of these resources, we talk about, Casey talks about this a lot, right? The more the community uses the resources, like the more people learn about it, right? So this is all part of like getting the word out and making sure everybody knows that these resources are available. All right, great. Uh, oh, uh, the bathroom. Where's the bathroom, right? Around the way, this way, if we go, if you, and just get, yeah. Yeah, perfect. Yes, yeah, yeah, yeah. And we're all friends here, so just, get up and go. Like, and I don't take a break in the 2 hours, so just to make sure that everyone feels comfortable, just, taking a break when you need one. All right, and then I think the last thing that Lori asked is, oh no, I already said this, so we're gonna ask for topics. So I have that on here. Already talked about that though. All right, so what are we here for? What are we talking about today? My favorite topic of all time, the stock market, right? This is obviously only one aspect of investing, right? It's a very limited aspect, but the reason that I am really passionate about talking about it and that we do it at the beginning of each year is this tends to be the part of investing that's the most like a black box for people, right? It's like most people, have they know a little about real estate or maybe a lot about real estate, um, and some of the other personal finance issues, but most people don't learn about investing, especially in the stock market. And so it can be really scary, right? Frightening for people. So this is just meant to kind of demystify some things. I'll tell you what I think is important as we go through. I mean, I will preface this with, I have like 60 slides and now we have an hour and 45 minutes to get through them all. Some of them are intro level and some of them are not, right? If you're overwhelmed, I would suggest just let it wash over you, right? Because part of what we believe here is like repetition is key. Nobody learns this the first time they hear it, period, right? So if this is the first time that you are exploring this topic, you will not know everything by the end, right? But you'll have heard some terms, then you'll hear them again, you'll come to some more meetings, you'll do some things, and it's a lifelong journey, truly, right? So there's some things that are intro level, there's something that are more advanced. I know there's a lot of headlines, there's a lot of TikToks about the stock market. So like this is kind of the place where if you see something that brings something up, ask it in real time. I might say like, oh, can we hit that at the end? Or I have a slide about that, or can we push it? Or I might answer it there in real time, but that's what this group is for. All right. Oh, there's all of these like disclaimers here. Like first and foremost, in every Us Women's Investing Group meeting, nothing in this room is intended to be individualized investing advice, right? By day, I'm a financial advisor. Casey's a financial planner. We have people who come in here who are attorneys and CPAs. Nothing here is advice. This is all education and my opinion. We've never had a problem with this before, but just so y'all know, whatever we're talking about here, I'm not telling you to go out and do any of it. I don't know any of you or your personal situation, right? This is just like education. There's a couple of other things in here, that I'm not going to worry too much about. Maybe the one thing I am going to point out is in investing and finance, one of the most important things to remember is we are forward looking, right? This is actually what I love about finance because a lot of people come into the group or come into their money journey with a lot of regret about things that happened in the past, right? Like, but luckily with finance, like the only thing that matters is what you do next, right? Everything else is in the past. Like we will look at things in the past to try to make predictions about what happens in the future, but finance is forward looking, right? That actually makes it really challenging to be an investor because we're trying to predict the future and no one has a crystal ball, right? But here we're going to be looking at forward looking estimates, forward looking statements, charts, where we're trying to tie all this together so that we can make good decisions based on the information that we have, all the while knowing there are no guarantees. Like almost nothing we talk about in the Austin Women's Investing Group is like a guaranteed thing, right? If you start hearing about guarantees, the only people that can guarantee something is a bank can guarantee the rate on like your high yield savings account, FDIC insured or a CD, and an insurance company can make you a guarantee. But other than that, we're talking about putting money at risk, right? So, and doing that mindfully. So this will be on the slide deck that I send out to you, so then you can, look at it really closely. Just really quickly, a little bit more about myself, since there are people here who don't know me already. I'm the founder of Black Barn Financial. We're a registered investment advisory and financial planning firm here in Austin. I'm the co-host of a podcast called Women on the Verge of a Financial Breakthrough that actually started with my friend Caitlin because of the Austin Women's Investing Group, right? So we cover just a lot of the stuff we talk about here, but I think it's a great podcast, right? Caitlin is very funny and very good at producing the podcast. Oh, hey, thank you. All right. We're just a couple of funny gals, yeah, talking about money. Founder of the Austin Women's Investing Group, obviously. I used to teach these classes through UT's informal classes called Investing for Beginners and Introduction to the Stock Market. Again, so I've been like doing this for a really long time. And then I have an MBA with a concentration in corporate finance, kind of my educational background. All right, stocks, let's go. All right, there's a lot of ways to talk about stocks. The way we're talking about it here is with a long-term perspective, right? Stocks for the long run. So we're really talking about buying stocks and owning them for a long period of time. So what we're not talking about is anything with trading. If you know people, know some dudes who do some day trading, or maybe you've dabbled in day trading or options trading, something like that. That's not what we're talking about here. We're gonna follow some advice from Uncle Warren Buffett. Someone is sitting in the shade today because someone planted a tree a long time ago. This is just this idea of long-term wealth building. It's boring, it's slow, but it is super powerful, right? You can benefit from it personally. You can be setting up generations in the future to benefit from it. Maybe you have benefited from people planting trees a long time ago, right? So that's what we're talking about is long-term investing. So just want to level set that right off the bat. And then really quickly, the stock market, some basics of the stock market. When we're talking about stocks, another word for it is equities. Those are interchangeable. We're talking about ownership of, in this case, ownership of a company, right? So I've got my iPhone in my pocket, right? And I own shares of Apple. I'm an owner of Apple, right? Like a super small, insignificant owner, right? But still an owner. That's really different from a lending relationship. So really important to be very clear about this. If I lend Apple money, they have to pay me back. We write a contract, right? We have a document. I'm going to lend you $1,000. You're going to pay me 3% per year for 10 years, and then you're going to give me my $1,000 back. That's bonds, loans, something different, right? Owning means, okay, if this company becomes more valuable over time because of the goods or the services or the products that it creates, owners benefit from that, right? Is anyone here a business owner or have been a business owner, right? So you kind of know how this works, right? You get paid after everybody else gets paid, right? And the idea is that money left over is what makes your company valuable. Maybe someone would want to buy it from you, right? That's what the stock market is. It's okay, we're buying little pieces of these companies and hoping, expecting that over time they become more valuable. Not all of them are going to become more valuable, right? That's the tricky part, right? Some of them are Enron, right? Some of them are, just whatever the equivalent of the horse and buggy companies from 1900s, right? But in the aggregate, we expect these companies to get more valuable over time. And so we're trying to participate in that. Price of a stock. So how are stock prices set? There is no third party involved here. It is buyers and sellers lining up and coming to a meeting of the minds. So most of this happens during the trading day, which as of now, there's actually this move towards 24-hour trading, which is going to be annoying. But as of now, the stock market opens at 8:30 Central and it closes at 3 during the business day. So that's when like most of the people in the world gather and they say, okay, well, I want to sell this. What'll you give me for it? Like, oh, I want to buy this. This is what I'll give you for it. And that meeting of the minds where a transaction happens is what a price is. And that's for everything, right? It's like your house. You can list your house for whatever price you want, whatever you think it's worth, but the price of that house is what someone will give you money for, right? So I can say my house is worth $1 million, but if someone only offers me 900,000, it's worth 900,000, right? So that's what's happening during the trading day with stocks, right? All these people lining up. If you have more buyers than sellers, then you have more demand, price goes up. If you have more sellers than buyers, price goes down, right? So there's always kind of this, the market's trying to find equilibrium. And stock prices are always changing because investors' expectations about the future are always changing. So all of the investors in the world, all of us, everybody out there who's doing this is taking in new information just in real time, right? Like what is happening all over the globe? How does this impact my optimism or pessimism about the future? How does that impact what I might buy or sell an asset for? This is like very overwhelming, right? It's nonstop. And I think part of the reason to like understand that that's what this is you're never going to know everything. And that change never stops, right? One of, I think, a trap that people fall into is I'll invest in the stock market when it's not so risky. I'm just telling you that will never happen, ever, right? Risks get resolved, but then new ones pop up, right? So, I mean, just think about the last week. Like, what's the news that we read in the last week? Nobody knew that was going to happen. And what's going to happen next week? God only knows, right? So just kind of keep that in mind. It's all like this future looking expectations. The two major components of stock prices, and we'll see a bunch of charts on this, are something called earnings. Another word for that is profits, and confidence, right? Or optimism and pessimism. So we'll see how those things work together. And both of those are always fluctuating. So that is why for most investors, the stock market is only appropriate for long-term money, right? These things can change just instantaneously. We all think everything's fine, like, oh my God, everything's not fine, right? So if you're in the stock market for a day or a week or a month or 1 year is even the short term, you're going to get just whipped around. So just know that going in. So now we're trying to stretch this out to 5 years, 10 years, 20 years, 50 years. Easier said than done. Okay, if we look back at 2025, I mean, it's a little bit of a roller coaster, right? So like, what are we looking at here? The blue line is the S&P 500. So think 500 large US companies, right? In all types of industries, all types of sectors. So the blue line is the S&P 500. So January, we started off okay. April was pretty rough. I don't know if you guys remember that, but that's that tariff announcement, right? Which in hindsight is like still crazy. The NASDAQ is the purple line. So the NASDAQ is also very large companies, US based, but more tech focused. And the Russell 2000, the yellow line, these are smaller companies. So still very large in the grand scheme of things. They're not small businesses, but they're small companies in terms of stocks. And so like they basically, they trend in the same direction, but they're not all exactly the same. All of our indexes here did fine first quarter, fell off a cliff in April, recovered, and ended higher on the year, right? This is, I mean, a pretty classic example of what the stock market looks like, right? It looks like a check mark. So if you can think back over 2025, all of the things that happened, this is how the stock market reflected all of that and what the stock market is expecting going forward. Any questions on any of this so far? All right, I'm going to keep going then. All right, so for 2025, the S&P 500, typically when I'm talking about the stock market, I'm talking about the S&P 500. It's just, again, like big US companies. They're all in a basket. You can see what the 500 companies are if you really want to. If I'm talking about the NASDAQ or something else, I'll try to tell you in advance. But here, the S&P 500, those annual returns fall here, like with history. So this is going all the way back, like on the calendar year, 1928 to 2025. This is like the distribution of returns for the stock market over that long period of time. So if I'm looking at this, like, okay, well, 17.4%, like, kind of seems like a lot. The long-term average is somewhere around 10%, but it's never actually 10%, right? Like, is it ever actually 10%? Kind of. There's a couple years that are very close to 10%, but not that many over that many years, right? So this is like in a very common category of somewhere between 10 and 20%. It's actually like the most common annual returns for the S&P 500. So this was like a basic stock market year in 2025. When I saw this chart, I was like, oh, that's interesting. And so on the downside, it's also more common for there to be like, it's also relatively common for there to be these big down years, right? So most people start getting concerned 10% down in the market. You start feeling it at 15%. As it nears 20%, people start getting a little bit panicky normally, right? And then you have some pretty serious crashes here, right? Where over the calendar year, the stock market fell by over 30% in 1 year, right? So we have 1937, 1931, and 2008. You guys remember those dark times, right? But most of the time, the stock market is trending upward. Not all the time, right? But most of the time. And just like average is not in the stock market's character. So if you're like, oh, I'm going to invest in the market for this year, and I think I'll probably get about 10%. Like, no, like picks, like it's going to be somewhere in this range and probably not 10%, right? Does this make sense so far? Any questions on this? Yeah. 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 I mean, yeah, I mean, like super basic math is if the stock market falls by 50%, you need 100% return to get back to even. Just to get back to even. I mean, but that is normal. Like the math of the stock market, the average 10% that we're kind of talking about, like your long-term expectation, includes the crashes and the recoveries, right? And so I think that it is hard to withstand a decline. And it is very easy to talk yourself into this idea the market fell by 50%. Now I need 100% to get back to even. But the fact is that is what has happened in the past. The market falls, sometimes falls by 10%, 20%, 30%, 40%, 54% during the financial crisis. And it is very easy to be like, how is the market going to recover? How are we going to get 100% return between now and some period of time in the future? And we'll talk a little bit about how that does actually happen. But where we are now at or near all-time highs, it has always happened. Yeah.
It's just reminded me because I have.
Yeah, yeah. Yeah, yeah. Right. You don't know when it's going to happen, right? This comes back to the long-term money, right? It took 5.5 years during, like from the financial crisis, took 5.5 years to get back to even. It's a long time to wait, but this is exactly why we're talking about long-term money. If you are saving money to put your kids through college and they're going to college next year, no, not the stock market. Sometimes people are like, I have money for a down payment. Should I put it all in the stock market so I can make a larger down payment a year from now? Are you nuts? No, don't do that, right? Do you want 20% less of a down payment? That is speculating, right? So if you're, as you shorten the time horizon, it's more like gambling. And we call it speculating is the nice word for it, right? It's more like fingers crossed, right? The longer we stretch it out, the more we're getting into, like some of the charts we'll look at, which are like, okay, I'm saving for retirement, or I'm in retirement, but I expect to live a long time. Or, you know what? I have enough. I'm actually saving for my kids and my grandkids. Or I'm a board member on a nonprofit, and this is like an endowment style. Like this is going to last forever, right? Or we want this to last forever. So all of these different time horizons, like you have to be really, when you're in the stock market, what we're talking about here, like you have to be able to stretch out that time horizon so you can get through all of these short terms to get to the long term. Yeah, you would have been. But how do you know? Yeah, yeah. I mean, we've got a lot of charts to look at that, right? So as we keep going, one of the things I love doing here, you guys, this is so fun. So we're gonna take a survey, right? So get your phones out. It's time to be, you're not being rude. It's gonna be great. I pay for this, so you're also not gonna get spammed, right? If you can scan this QR code, the question is, how do you think the stock market will do in 2026? So I'm turned this on. So you can either use the QR code or text your vote. Can you see this to 512-866-8020? And this is just like, what do we think as a group 2026 is going to be like? It is 512-866-8020. Oh, there's also one of those little hashtag numbers too, which is 12462. That's a lot of numbers, y'all. I'm sorry. Maybe I can zoom in. No. Yeah, or just come to the front and use the QR code. Oh, is it showing you the in real time too? So fun. Yeah. 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 Let's see. Let's see what we see. Yeah, no, thank you, everybody. It's more fun, like the more people who can participate too. So thank you for. All right, so this is great. We're coming out. A lot of people are like, fine, right? And I know we're not like putting numbers around this. It's like, yeah, yeah. So 4 people so far have said great. 6 people so far have said good. 12 people are like, it'll be fine. 7 are like, nope, it's gonna be bad. We don't have any terrible people? No one thinks it's gonna be super terrible? That's surprising. I usually have one bear. Right. All right. Has everybody, Laura, are you gonna get in there? Did you vote already? Okay. All right. Has everyone who's going to vote gotten a chance to vote? All right. So this is interesting. All right. Let's just kind of remember this as we go forward. All right. I'm going to pause this guy. So we're like generally like pretty optimistic, I would say. More optimistic than we were last year. Okay. Let me figure out. This is where like I have to go from window to window. You get out of here. Okay. Next, keep your phones out. Yeah. Yeah. We'll talk about that, right? Like what can you expect after a good year, right? There is like a little bit of like magical thinking or superstitious thinking that comes along with the stock market a lot of times, right? Like if it goes up, what do you think the next part of that is? You think it's going to continue to go up? Because I thought everyone was going to say, well, it has to come down, right? So we'll talk about some of those things, right? Like, are stock returns kind of self-perpetuating, right? Or are they like sequentially one after another? Like, we've got charts, right? So the next poll we're going to do, I love this, you guys. This is one of those word clouds, right? So I'm going to turn this on. Same thing. I think it's the same QR code. So I think you can just do it again once I turn this on. So think about and try to use like one word or one phrase. If you were making the case that the stock market is going to do poorly in 2026. So we call this a bearish outlook, right? If we have a bearish outlook or we're making the case for the market going down, why do we think it's going to go down? Oh, how do I turn this into word cloud? Oh, shoot, like, I don't know if maybe I don't have it turned on the right thing. So we're just going to do this. We're just going to read them as they come up, right? And then try to remember what keeps coming up, right? I mean, what keeps coming up? Yeah, here we go. Yeah. So whatever you think is a reason to not invest in stocks in 2026, that's what we're trying to come up with. So it can be a little bit of everything, right? Like, what's in the back of your mind, or what makes you pessimistic about 2026 when it comes to putting your money somewhere, right? Or in the stock market specifically, right? So we've got unrest, we've got foreign policy and war, we've got tariffs, we've got Trump, we've got AI crash. I think that's the first AI crash has come up. We've got balance sheets. We've got unrest. We got more Trump. We've got rates, right? So I'm assuming that someone's interest rates. We've got politics. We've got more Trumps. We've got war. Yeah. Oh, the government is shady. Interesting. I missed that one. We've got ICE on there. So this is, remember, it's all like anonymous, right? All right, so there's reasons that we come up with to not do this, right? We're talking about putting money at risk. We've just looked at a chart, said like, oh, like crap, like the stock market can fall by 5%, 10%, 20%, 30%. I don't want to be exposed to that for these reasons, right? So that makes sense. We're not being reckless. We're being mindful with our investments, right? And part of investing is figuring out what risks you're willing to take and what risks you're not willing to take. So certainly, like, with the kind of the overarching theme, I think here being politics, right? And politicians' impact on the markets. We talked about this a lot last year, right? And we actually talked a lot about like the danger of doing that. And we'll talk about this with the slides. The stock market only cares about money. That's it. It does not care about your feelings. It does not care about most social policy, maybe any social policy. It has no moral compass. It literally only cares about money. And so when we're talking about politics, you have to take an extra step, right? How does this thing impact money? How is it financial, right? It doesn't mean it's not important. I hope no one is getting that impression that it's not important. It's just that with the stock market, it is only money all the time. So just we'll look more at that going forward. All right, thank you everybody for participating. This is so fun. Okay, so we've been doing this long enough that we can go back. You guys, this was so cool. Was anyone here at this meeting right before COVID, 2020, at the library? They sent the New York Times to come like take our picture, and they did a whole article about investment clubs, right? And so we were in the New York Times, which nobody read because then COVID happened, right? And nobody cared. So it was awesome timing, right? We're gonna look at the same chart that's in the background, right? So if we get in the Wayback Machine, we can, like, this group, we've been keeping track of this like for a long time. So in 2020, what did we think was going to be important in the stock market? All right, we got some things up there. Bernie was not important in the stock market that year, but coronavirus was. That was important, right? So we're able to kind of pick up on these things, like what might be important, but also note we're identifying a lot of stuff that is not important, right? Because that's how we feel. So we got a lot of stuff up here. By 2021, we did this. We were not in person, we were online, but here, like civil unrest, yikers, right? Like overvalued stocks. So we still have a lot of things on here from January 2021. January 2022, I mean, this is really good, you guys. Like we somehow came up with Fed rate hikes, and that is what happened that year. And the stock market did horrible in 2022. So kudos to us. 2023, we're still caught up in the inflation story by the beginning of 2023, because that was the whole story in 2022. But in 2023, inflation subsided and the market did really well. So 1 year ago, we were all really, really thinking about the election results, right? It was after the election, but we didn't know what was going to go on. We didn't know what was going to happen. So everyone was very concerned about that. And oh, wait, hold on. Oh, that was the election coming up. I'm sorry. And then after the election happened, this is from a year ago. The broligarchy is so funny. Like, I don't know who put that term in there, but I think that's so funny. So tariffs is right in the middle, kind of this Trump tantrums, right, are in there. And that did end up having a huge impact. Like tariffs are directly related to money, right? Some of these other things like are not directly related to money. So I'd love going back and seeing what we thought January 2025. All right, so 2026, this is my list. These are things that I think are interesting to talk about and bring up if I'm making the bearish case for stocks. Let me see if I can figure out, I don't know how to move this thing, by the way. Get out of the way. I'm gonna just drag it up. All right, that's good enough, great. All right, bearish case for stocks 2026. My first one, and this is very new, so I don't really know how to think about this yet, is geopolitics is back at the forefront, right? Last week, I don't know, a lot's changing. So I just put regime change in Venezuela, Iran, Greenland, like what is happening, right? Like these things are expensive and destabilizing, right? So we still don't know, like, are we sending troops places? Like, are we investing? Like, nobody knows yet, like, what the plan is, which is kind of a problem, but that could be destabilizing in that those things are expensive, right? If we send military to places, it costs money, and who pays for it, right? Yeah, right. The main one until the top of the bullet point until last week for me was this idea of valuations could be too high. So said another way, the price of stocks is too high. This is reflected in something called the PE ratio that we'll definitely look at, probably more than anyone wants to. This idea of overexuberance inflating an AI bubble is a big theme, a big topic in the stock market. Inflation, right? Like inflation might be getting stuck too high. So you guys, maybe you know this, maybe you don't, but the Federal Reserve, who set very short-term interest rates, and they're kind of in charge of keeping inflation in check while also keeping unemployment low. They have a 2% annual inflation target. And we're kind of getting stuck at 3%, right? So it's concerning, right? And then we just have to figure out, well, how concerning is it? If inflation starts to move higher, so in 2022, this was the story. Inflation kept moving higher, and it was moving higher faster, right? There was like this COVID whipsaw effect that we were all experiencing. Remember the supply chains and the what have you. When things change fast, markets do not like that, right? They like things to be like gradual and predictable, though they hardly ever are. So that's a bearish case, right? This idea of tariff-driven inflation, it hasn't really shown up yet. We'll look at the charts, but it doesn't mean it's not going to show up. Then here we have like year 2 of the presidential cycle. I'm not like a big presidential cycle person, but we'll look at it. It could be part of this bearish case. There is a new chair of the Federal Reserve taking over the Federal Open Markets Committee in May. I just put up there the 12-person Federal Open Markets Committee, just to remind everyone that there's a chairperson. So right now, Jerome Powell, he's the chair of the board, but there's 12 people on the board that vote on interest rates. So just trying to put that kind of back into perspective a little bit. There's evidence of a weakening job market. I know people have experienced that, super painful, right? Higher mortgage rates than what people got used to are continuing to weigh on the real estate market and affordability. That flows through in a lot of kind of, I think, unexpected ways. We're coming off this monster 3-year time period of stock market returns, 2023, 2024, 2025. The market has done well. So kind of either coming back to it's time to take a breather, or what goes up must come down. That could be a bearish case. Maybe we've come too far too fast. And then just kind of always on this list is the national debt and projected deficits. That's just, I don't know if it's going to change. It's just always going to be on there, right? So that's always on there. So these are my bearish cases. So I'm going to just show some charts and try to first make the case that we should all be like a little bit worried. The way that over the last week, I'm thinking about this geopolitical risk piece is coming back to this idea of international conflicts can be expensive. They don't have to be expensive, but they can be. And who pays for it, right? Like the government pays for it, right? If you're sending the military in, right? And then taxpayers pay for it, right? Or not, or we just run deficits. So kind of what I'm showing here is this chart that's showing the federal debt, so in dollars, and then like dividing it by GDP, right? GDP is, you can kind of think of it like how much mortgage debt you have versus how much money you make, right? So we're trying to compare these two things together to get an idea. So our debt to GDP ratio is trending upward, up and to the right, right? There's lots and lots and lots of discussion around this, right? Is it a problem? Is it not a problem? But it's going up and to the right. So if you think it's a problem, you're like, well, okay, we're kind of like, one of the things here that's not on the chart is the debt to GDP ratio tends to go up during times of crisis because the government steps in with support for people, right? So most recently that happened during COVID, right? Economy shuts down, government sends checks, right? So that was very, very straightforward. In previous crises, it's not as straightforward as that, but the idea is there's a crisis and the government responds through spending, right? In here in 1990, do you guys remember the first Gulf War, right? There was intervention, regime change, right? In the first Gulf War, sent troops in, right? Like that's expensive. You got to get all those people over there, right? Like not to mention like the human aspect, right, of it. So that's how I'm thinking about the geopolitical risk. Like, okay, well, it flows through into how much can we actually afford to do, right? I don't know the answer, by the way. Just making the case that it's a risk. Okay, so this is the one that again, until about a week ago, this was the main one. So we're going to talk a little bit about the price to earnings ratio. So I said before that the main driver of stock prices is earnings. I'm actually going to go forward to a chart here. Oh, no, don't look at that. Don't look. There's this relationship between price of a stock, which on this line is the red line, and earnings, which is the blue line. So if you think about like your household, money comes in, you pay a bunch of bills, you pay your taxes, you pay your debt service on your mortgage and your car loan and your student loans, and then there's money left over, right? So kind of like the analogy is for companies, I go to the Apple store, I give them $1,000 for this phone. They take the $1,000, they pay for the raw materials to create the phone. They pay their engineers and all the people that made the phone. They pay to keep the lights on at the office. They pay any debt that they've borrowed. They pay taxes, and then there's something left over, which is earnings or profits or net earnings or net profits or the bottom line, right? So it's all the money that's flowed down, trickled down to the bottom. So we can see here very clearly this relationship between earnings and prices, right? This is the fundamental underpinning of stocks. Okay. This is really, like, I think this is of utmost importance because I hear a lot, like stocks are like gambling, right? It's not like gambling. Like there's this economic or this business underpinning to what a stock is worth in its earnings. So if you expect earnings to go up, then prices should follow. If you expect earnings to go down, then prices should follow. Does that make sense? Don't look. Going back. I need to remember next year to switch the order of that. So here we're talking about the price of a stock in the numerator. So we're going back to, my daughter is learning fractions and decimals right now. So it's like 4th grade math, right? The price is in the numerator, earnings are in the denominator. That's it. That's what this is, price to earnings ratio, right? What we're showing here is the price to earnings ratio on different parts of the stock market over a long period of time. So this is 2000, this is 2025, and then we're kind of in here, we're not too far into 2026 yet. The reason this is important is, do you guys know, does everyone know like the ratio, like price per square foot of a house, right? Like it's like same thing, just arithmetic, right? Price per square foot. This is like the price per square foot of the stock market. How much are you willing to pay for something? So here, the pink line is what people call the Magnificent Seven, the Mag 7. So these are the 7 big tech companies that we could probably name, right? Amazon, Apple, Microsoft, NVIDIA, help me out, Google, Alphabet. What's the other one? NVIDIA, Tesla. Nope, not yet. All right, so those are our 7. Did everyone kind of get what those were? So the biggest tech companies have gone up in price the most, their stocks, but they also earn a lot of money. So we're trying to quantify that. We're saying here, the way we say it is that the Mag 7 as a group, if we put these 7 stocks in a bucket, they trade at a PE ratio of about, let's call it 29. You say 29 times or 29x. If we think about just the S&P 500, so those 7 companies, but then the 493 other companies in the S&P 500, we can see that the PE ratio is a lot lower, right? And then if we look at the poor little green line and the blue line, these are mid-sized companies and small companies, mid-cap and small cap. We can see they trade at an even lower PE ratio. So the way that people use this is like, okay, like, which would you rather have? Would you rather buy a house at a high price per square foot or a low price per square foot? Right? Some people like have a very strong opinion on that, right? You would kind of expect that if it's a higher price per square foot, there's something about the property that makes it more valuable, right? Like school district, neighborhood, like is there new development coming in, whatever it is, right? It's kind of the same thing here, right? Why would you pay so much more for the Mag 7 than you would for all of these little companies you've never heard of, right? There's lots of reasons, right? Like they earn a whole bunch more. They have everything that's valuable in today's economy, data, users, technology, right? What's up? Prospects, yeah. They have all the stuff that everybody needs, right? And these people don't. And that's why we would pay more. Or it could be like, hey, remember what a bubble looks like? You guys remember the dot-com bubble? Right? So the internet was the technology and people were super excited about it. And so they bought at a higher and higher price, but didn't have the earnings to support it, right? That's what a bubble is when you're paying a really high price and that fundamental underpinning is not there, right? So for my realtors in the house, I'm just gonna harken back a few years, just a little bit, right? To like the frenzy of, what year was it? I'm talking about 2021 and 2022 in recent Austin, right? Where the stories were like people are just rolling into town and paying whatever for whatever, right? like wildness. And so that can happen in the stock market too. That's what a bubble is. A bubble does not mean high prices. Sometimes the prices are justified. A bubble is when it's high prices that are not justified, right? So right now, like everybody's like looking at this like, well, this looks like it's nearly, so this, the S&P 500 is at 22 times. The only other time it's been that high is that coming out of COVID, like the COVID recovery in the stock market. And then after that, the only time it's been higher is during the dot-com bubble. And this freaks people out, right? So maybe it freaks you out. That would be why you'd be like, I don't want to pay 22 times for the S&P 500. I'm going to wait until it's lower. And I expect it to be lower in the future, right? Does that idea of like the PE ratio like kind of make sense? Like as a concept? Yeah, yeah. 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 What a great question. I don't know. the way that I look at this, right, is I look at like the S&P 500, and there's a, it doesn't quite show it here, but you do kind of have to think, did they say it like the four most like dangerous words in the stock market? Like this time is different, right? Like, has something happened to justify, if we think that the normal PE ratio of the S&P 500, so the red line, we're like, okay, like on average, it's somewhere around like 16, let's call it. Has anything happened in the recent past to justify it not being 16 anymore, it being higher than that? I would say the case would be like technology, different, right? Like kind of the winner take most, over earning. Like these huge companies don't grow and then die yet. They grow and then they keep growing really fast. Yeah, they. Yeah. Mm-hmm. Yeah. Yeah. The bearish case, people. All right, who is with Faye on the bearish case? Yeah. 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 This sounds very bearish. What else you got? Like, yes, this is the bearish case, right? Like, this is too much. There's too many problems to justify this price, right? Yes. Yeah. Yeah. Yeah, circular financing. Yep. Yep. Yeah. Very good. Yes. Like those things, these things are all true, right? Yeah. 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 I mean, these are all like the justifications for this is too high, right? If, would you like, if we go back to like the housing analogy, would you pay a high price per square foot for a house that has a lot of problems that come up in inspection, right? Like problems under the hood. So this is the value, this is exactly the valuation argument. You guys just made it, right? Good job. Yes, yeah. So they would be like the 7 largest companies in the S&P 500. No, this is still with them in it, but they're right. So you might continue to say like, okay, I don't like the stock market is, maybe the stock market is fine if I exclude the Magnificent Seven, and there are investing solutions for that. I want to invest in the S&P 493, right? And figure that out, right? Or like the way that people typically do it is if you invest in like a normal S&P 500 fund, it's what's called market cap weighted. That means the Mag 7 are the largest companies, so they're weighted the most in the fund. But there are lots of solutions called equally weighted. It means that of the S&P 500, all 500 companies are given the same weighting. So it would, so versus the S&P 500, all of the other companies, like everything's the same in an equally weighted ETF. So that's another way to pretty easily get around this Mag 7 problem if it's giving you heartburn. What if they run out of money, guys? This like inflation getting stuck at 3% is another bearish case. It's hard to reduce rates if inflation is stuck somewhere, right? Also, people don't like 3% inflation or higher. So this like could continue. It's also still very unclear as to how the tariff-driven inflation is going to show up, right? So it looks like the effective tariff rate has peaked at about 10%, right? So this is these blue lines. The dark blue line is the effective tariff rate. It kind of maxed out there at 10-ish. The blue line on this other axis are the receipts actually received, like the dollars and tariffs paid. So perhaps that's topped out. But like this, a lot of the tariff, what people thought would lead to higher prices hasn't actually happened. So there's a question about whether it's just taking a long time or whether it's not going to happen. Like there's something too complex happening that we're not accounting for. And like the Supreme Court's supposed to rule on the constitutionality of these tariffs. I thought like there was something in the news that they were going to release the ruling on Friday and they didn't. So that happens any day now. So there's also like, well, what happens if all of these tariffs that have been collected are unconstitutional? Like what happens then? Do we get our money back? I bought this table from Spain and I saved the receipt, right? It was like $110 tariff that FedEx sent me. And so I saved it because I want my money back. But how do we, that seems hard. So that's like, still like, kind of like, what are these things that are either causing panic or causing heartburn for trying to make these decisions? Year 2 of the presidential cycle, right? So if you're kind of into this idea that there's some predictions that can be made from the presidential cycle, again, like I'm very like loose about this type of thing. Year 2 of the 4-year presidential cycle has historically been by far the weakest, right? So here, like overall the presidential cycles, year 1 is usually pretty good, year 2 is usually pretty bad, year 3 is usually great, and then year 4 is like fine, right? So we are in year 2. And then this chart is showing this dark blue line is like the average, like the composite of all of these presidential years. And the blue line is what 2025 looks like. So if we expect something like this relationship to hold for whatever reason, then that would be kind of another argument for it being a tough year, right? Just to get in the Wayback Machine, in year 2 of the first Trump administration, which was calendar year 2018, the S&P fell 6.2%. The second year of the Biden administration, 2022, the stock market fell 19.4%. That was that inflation year, right? So that could be like, okay, like bearish case. Oh, jobs, right? This has changed and continues to be changing. Last year, the year before, when I showed this chart, what was extraordinary was the number of job openings, black line, being so much higher than the number of job seekers, right? That relationship, now they are very close to each other, right? There used to be lots. Oh, good question. This goes back to 2000. So 25-ish years. If people can pretty easily find a job because there's plenty of openings, you got lots of people kind of doing their thing, upgrading their salary. You have all that money kind of flowing through the economy. If you have people kind of stuck in jobs, afraid to leave, you have companies afraid to hire, then it just starts gumming up the works, right? Like I'm guessing there's people in this room who've experienced this. In 2025, it's been a minute since we've had that dynamic, right? Like if we think back to the recent past, like post-COVID, workers, employees had a lot of power, right? A lot of power to command higher salaries, better benefits, work from home, and that is going away, right? This is actually probably like, for those of you who are still in the workforce, like the actual biggest impact to your financial life is this relationship, right? Because it's your income, which is a huge asset. So, they're like right on top of each other. The job openings barely higher than the job seekers, right? So it's kind of like at the end here, it's almost like equilibrium. Whereas in the past, there have been way more job openings than people looking for jobs. And now it's very close. I mean, I think it's a little bit of maybe the residual COVID whiplash, right? People got laid off, people got rehired. Do you guys remember just a couple of years ago where like companies were hiring everybody, anybody and everybody, right? Overhired, were afraid to lay people off. And now you probably have AI and technology and a recalibration of what the right staffing level is, leading companies to be like, okay, we don't need as many people. So we don't have as many job openings. But then you have a bunch of people who are like, hey, I'm looking for work, right? And there aren't as many job openings. Yeah, this is, yeah, pretty much like here, like I think this red spike is COVID, right? Yeah, this is 2020. This is, this is post-financial crisis. Financial crisis layoffs. Yeah, this is, this starts in 2008, 2009. Yeah. Right? So people get laid off in a recession, or people looking for jobs goes way up, people hiring goes way down, right? That's like a pretty classic recession impact. But it's been flipped for the recent past. Again, like this idea that workers for some period of time had a lot more power. Good to know if that relationship is not here anymore. Yeah. Oh, that's a good question. I don't know. Should ask like the Chamber of Commerce. Yeah. Yes. Oh my gosh, I love that. Yeah. And this is from the BLS, the Bureau of Labor Statistics, right? So there are so many statistics, you guys. Like if you have like a vibe or a feeling about something, you should be able to find a statistic to support it, right? Which is why I end up showing all of these charts. Because sometimes we have feelings that aren't supported by the numbers, right? That doesn't mean they're wrong. It just means you should know that, right? That You might not be in line with what everybody else is looking at. So if you're like ready to, I don't know, just leave your job and find something else without having a real plan to do that, like you just need to know that 2026 is not 2022, right? Mm-hmm. Yeah. Yeah. 6 months. I had someone 10 months. Yeah. 10 months. Yeah. 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 Oh, 2 years. Yeah. 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 It's rough out there. Commercial for Dress for Success Austin, career readiness, and getting all of that, all your ducks in a row if you're out there looking. Real estate affordability still remaining a challenge, right? This chart is showing, what are we looking at here? So this is the monthly payment. So the hours of earnings needed, with like the hours per earnings to afford the average mortgage payment, because what this is looking at, right? So this is showing what it actually is, right? So the number of hours you need to work to afford a mortgage is much higher than it's been in the recent past. And if rates were at 5% instead of what they are now, Samina, help me out. Low sixes. Yeah. I think I saw 5.99 on Friday, right? They changed like 5, but that's very close to 6, right? This is what it would be if rates were lower. I will say, like, everybody's kind of waiting for rates to come down. We've been talking about this for many months in Lost Women's Investing Group. I think we all just need to, if you're going to buy a house, like, you're not going to be able to wait forever, right? Or maybe you can wait forever if it's unaffordable, right? Maybe you're going to be forced to wait forever. Yeah. 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 Mm-hmm. Mm-hmm. Hmm. How much lower? Hmm. 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 Mm-hmm. Mm-hmm. Yeah. 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 Yep. Mm-hmm. Mm. Yeah. Mm. 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 Mm-hmm. Mm. Mm-hmm. Mm-hmm. So, but yeah, I mean, yeah, I mean, I really love that. I think like when it comes to buying real estate, I mean, talk to your experts, talk to realtors who know what the price of things actually are, talk to your mortgage brokers who know what the price of money actually is. It's okay to run numbers on your own, but if you're serious, you need to talk to people who have like the real info, right? So just like a commercial for um, like tapping into people's expertise, right? Because you can talk yourself into a purchase or out of a purchase doing back of envelope, right? So just like a quick commercial for that. But this still, like, I know it like kind of continues to give people heartburn is this idea of affordability. Yeah, yeah, very good. Hopefully we'll have some more real estate focus, especially if that's what you guys want to know about, right? Is coming back to real estate, you know, first time home buying, investment properties, things like that. It's all numbers. All investing is numbers, right? All right, you guys. So that was the bearish case. Are people feeling pretty glum? All right. It's like sell now, right? All right. So there's a lot of challenges out there, but maybe there's some reasons to be cheerful. I don't know. Okay. So let's do this again. We're going to pull out your phones again and do the same thing. If you are making the bullish case, so bullish case, think of a bull with their horns and they're tossing someone up into the air. Like the market's going to go up, prices are going to go up. Hello. Well, maybe we're not going to get to take this do this presentation. Maybe I have to close. Oh, I have to stop. Oh, I knew I was going to muck this all up somehow. You pause, refresh. Just be thinking about what you're going to say when I finally get to the right thing. It's going to be wonderful. Or I may just have to take a survey. I don't know. Maybe I need to re-log in. You guys. What happens if you use, like, if I have this on, does anything happen if you plug something in for me? If you put in, I don't know, what's something good? Test. Yeah. It's always something. Anything? No? Oh, you guys. So sad. I really wanted to know what you thought. I know, we're just going to shout it out here in a minute, but I don't know how to log out and log back in. It's just giving me the, oh, wait. All right. I think we're just going to have to shout it out, you guys. All right. If you thought of, if you're willing to share with the group, make the bullish case for investing in the stock market in 2026. AI enthusiasm. So is it a bearish case? Is it a bullish case? Yes and yes. Any other like bullet, like who wants to expand on AI? Or is it just like general AI enthusiasm is it's certainly enough. Yeah. Yeah. People are very enthusiastic about this technology, the deployment, what it can possibly do for the economy. So that's interesting. Like it could move from a Mag 7 story to other people participating story, perhaps. Mm-hmm. Mm-hmm. Yeah, yeah. Someone plug in AI enthusiasm in here and see if it pops up. Yeah, yeah, yeah. Because I'm kind of hearing like maybe like the solutions to the problem, like making money from taking the problem and then making money from the solutions around AI. That's really good. Nina? Mm, mm, mhm, 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 mm. Invading Venezuela is bullish. Yeah. Oh, yeah. 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 There you go. Yeah. Really good. uh, so I think this is like, I think it's just my computer is like on overload with the Zoom and the polls. So I think it's coming in now. If you have like, if you're willing to submit what you think, why might the stock market do well in 2026? Oh, I like this one. People still need stuff and keep buying, right? Because I mean, that really is like at the most basic level, like the lifeblood of the US economy is the consumer, right? There you go. Yeah. So if people have money and still need to buy stuff, we can keep this thing going, right? Yeah. Who put wealthy retirees? I love it. I have a chart about that. Yeah. So enthusiasm, keep buying. AI is a part of that. Boomers leaving market. Oh, I don't. That's interesting. Like how that would be bullish, though. Yeah. This one's bull. Wealth transfer, is that in there? I heard someone say it. That's fun. I mean, so these are all, yes, like these are the ones that are kind of top of mind for people, right? Where you're coming up with, okay, if I had $1 million, what are the reasons I would chuck it into the stock market beginning of the year, right? These are all really good reasons. All right, so come back here. Thank you for sharing, everybody. Again, like we've been doing this for a couple of years, we can see like what did we think was bullish at the beginning of January 2020. Yeah, so there was like 2019, there was like man, it seems like so long ago, right? FOMO stands for fear of missing out. Like that's really common in the stock market, right? Stock market pulls up and away from you, and you were scared in April 2025 or March 2020 or December 2018 is 40% ahead of you, right? So that is part of a market dynamic as FOMO, right? It was an election year, so we somehow thought that would be bullish, right? I don't know if we have war on there as bullish. That's who knows, maybe, right? I mean, it can be if it's funneling, if you're invested in the right stocks, I suppose, right? So for 2021, what were we thinking at the beginning of January 2021? Like technology already was coming on as like, okay, this is the future of people, right? It also felt like maybe there was a little bit more stability there. Why the stock market might do well at the beginning of 2022, COVID fatigue. That's actually a really good one that actually is kind of what created the inflation, right? Do you guys remember like the revenge spending that everybody went on, right, in 2022? Like everybody wanted to go everywhere and do everything, and there weren't enough people to handle it, right? It was a crazy supply demand issue, right? So if it hadn't led to incredibly high inflation, that probably would have been good for the market, but it didn't. So, oh, TINA stands for there is no alternative. So back in the day, 0% interest rates, this acronym TINA meant like, are you just going to leave your money in cash at 0%? Like like you're forced to do something else with it, right? They're going to force you to make money by not letting you stay in cash at 0%. So now there is an alternative, right? Now rates are at, I don't know, 3.5% on a high yield savings account. You're like, oh, like maybe for some of you, you're like, you know what? More than zero, right? Like this is good enough for me. But zero is zero, right? So that's where the TINA acronym came in. We still had FOMO over there. Okay, beginning of January 2023, we're starting to think about like a rebound in the market after a horrible 2022. Is the Fed going to stop raising rates, or have they stopped raising rates? That would be good for the market. So we keyed in on that. By the beginning of January 2024, oh, now we're like feeling the love from lower interest rates, and we're really keying in on the AI. And then 1 year ago, really cynical people in here. Right? AI is still the big one, right? Yeah, that is interesting because it didn't really show up too much. It was a little, maybe little on the other ones. Impact of crypto. You're right, it is showing up more here than it has in the past. But that crypto is like a supporter of the stock market, right? Is an interesting idea. All right, so if I'm making the bullish case for stocks, and I almost always am, you guys, like you guys now have known me for a long time, I'm almost always making the long-term bullish case for stocks, right? First, like the stock market is in a bull market, which is in and of itself the bull market case for being in the stock market, right? It means like we'll look at charts, bull markets can last a long time. So this idea of what goes up must come down. It's not year over year, and it's like the market can go up farther than you think it can go, right? Even if it does eventually come down, you always have to be ready for downturns. We'll look at charts. Earnings are trending upward. We already got a preview of that chart. I'm going to take that valuation argument and come back to a new ratio. I can't remember if we've talked about in the past, called the PEG ratio, or the price to earnings growth ratio. If you look at the price to earnings ratio and then account for how fast earnings are growing, maybe valuations don't look as high as they do if you exclude earnings growth. Inflation has peaked and might be moderating. So this is the argument that even if inflation is at 3%, if it's not changing, then we get used to it, right? That the change in the inflation rate is actually what freaks people out, right? Technology-driven innovation, AI, robotics, et cetera, is in early stages and also is disinflationary. So technology tends to bring the price of things down, right? So then the price for like, you know, your phone, your computer is coming down, you have money to spend elsewhere. Consumer is strong, still do have jobs, low unemployment rate in the aggregate, low debt, cash in your pockets. Household wealth, we'll spotlight baby boomer wealth. We did this last year for the first time, and we'll do it again. And the US economy is still growing. Okay, so bull markets can last a long time, like longer than you think. So this goes all the way back to 1928. The green are bull markets. A bull market is when the market is going up without a 20% decline, right? So maybe it falls by 15%, maybe it falls by 19.3%, like our current bull market. I think we saw 19.3% in April of last year, but that didn't break the streak, right? So that the green line is when the market is going up without pulling back by more than 20%. That's how we're defining it. So the S&P 500, again, like the stock market, the price of the stock market is the blue line chugging up over time. Sometimes it goes up, sometimes it goes down, sometimes it goes sideways. But these periods of time where the stock market is growing, especially in the modern era, can last a really long time. So if we come over here, this is the number of days that a bull market can last. Does it have in here? This is the one that started in 2022. So we are at about 1,156 days in the current bull market. This one that started at the end in March of 2009 lasted 4,000 days. This says 3,999. There are a lot of instances here of bull markets that have lasted as long or longer than this one we're currently in. We've never had one that lasts forever, right? That they can last a really long time. A trap that people fall in is kind of related to the FOMO, right? It's, well, I'm going to wait for an X% pullback, right? Last year, if you had waited after tariffs, I don't know if we got a 5% pullback after April, right? So some people will be like, well, I'm going to wait for prices to come down, right? What's the percentage? 5%? Is it 10%? Is it 20%? What if you don't get there, right? What if it keeps going up and runs away from you? So it's very tricky to kind of have that type of strategy for getting into the stock market, right? Any questions on this? Like this, like long, like bull markets can last a long time. That's surprising to anybody? Yeah. These are all nominal numbers, so no. On the inflation front, since it's come up a couple times, like inflation adjustment, the change in price of things is almost always reported on a nominal basis. So it's just what the percentage change is, and then inflation is reported separately. Sometimes you'll have something that's called, that is inflation adjusted or real rate of return, but typically it's not, right? Unless it says otherwise. But over this period of time, like, well, it's not over the whole period of time, the inflation rate since like the early 80s tends to average somewhere around, let's call it 3.5% per year, especially like you had high inflation in the 80s, right? The recent past, like since the financial crisis, it was really having a hard time. Inflation didn't really get above 2% for a long time until 2022. And now it's at 3%. There's another, like kind of going back to this idea of like the market can stay high or be trending upward for long periods of time, because since 1950, since 1900s, like for like the entire time series here, the market has trended up and to the right. So that means most of the time the market is at or near all-time highs, right? It keeps reaching all-time highs. And so again, this idea of sometimes people say, well, it goes back to like, I'm going to wait for it to come down. It's gone up too far. I'm going to wait. I always think this chart is super fascinating. 64% of the time, the market is within 10% of all-time highs, right? So most of the time, the market isn't that far off from all-time highs, and it might be on its way to a new all-time high. Now, of course, like when it goes bad, it goes really bad, really fast, right? Like little red marks. Yeah. Within all time, yeah. I mean, so all of these greens are within 1% of all-time highs. So if you look at all these green dots, like this was an all-time high at that time, right? Like it's a lot of green dots up there. Yeah. 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 Within 1%. So I'm just like approximating, like that's pretty close to all-time highs, right? Like within 1%, like it hits it, maybe comes down a little bit. But sorry, the green is, the little green dots on the chart are when the price of the S&P 500 was within 1% of all-time highs. So it was either literally at all-time highs or down just a squoosh, right? So very, very close. On the other side, the red is when the market has fallen 20% or more from its all-time highs. Like that time the market is really, really down really dramatically, the actual number of days is relatively small. There's this, my favorite stock market saying is, bear markets take the elevator, bull markets take the stairs, right? So when things go bad, they go bad so fast that it takes your breath away, right? So you can see that on this chart. There's these like very sharp declines because as humans, we all panic at the same time, right? It's like human nature. Like, oh my gosh, like things are bad and they're getting worse. And oh my God, I'm going to lose all my money. I'm selling everything. It all happens really fast, right? And then like, well, I'm going to wait for things to get better. Like, oh, it looks like things are getting better. I'm going to wait for the market to pull back. Oh, the market's not pulling back. Oh my gosh, it's never going to pull back again. I'm going to get back in. We're all subject to this fear and greed cycle. It's a behavioral thing that's very well documented in the stock market. And we all do it together, right? So like we've been in a bull market since October 2022. Do people like, maybe some people do people love this bull market? Like most people aren't like, yeah, some people are, but most people are like, I don't know. Feels pretty sketchy to me, right? That's, again, just kind of human nature. So when things go bad, they go bad really, really fast. That's probably the most important thing to remember about stock investing. It goes bad all at the same time. And if you think you have the fortitude to jump in when things are bad, I really hope you do. But most people don't. Because when things are bad, there's a reason, like a really good reason that things are scary. Yes, buy more. Some, I know, like looking back, you're like, oh, that 1 week in April when we thought one person was going to destroy the global economy, why didn't we buy, right? A, it was a week, right? B, it was crazy and it was really scary. Like, what is happening? Like everybody at the same time looking at the same thing, like what is happening? And that is like these crises that precipitate these crashes. That's what it is. Everybody's looking at the same thing. Everybody's very concerned because it is very concerning, right? Crashes don't happen when everybody feels really good about things, right? So we will figure out, like, have to think about ways to get around that. Got some ideas for you, but this idea that, again, like markets trend up and to the right, it's like a bullish case. Maybe not for 2026, maybe just for like all the time, right? Having some money in the stock market and letting it sit there for a long period of time. So the economy still growing is something that we can track in real time. They report GDP numbers, gross domestic product. That's how we measure whether the economy is growing, whether it's over 0% or below 0%. They report it. So they report it the official reports happen a quarter late, right? So whatever quarter we're in now, we're in Q1 2026. Pretty soon we'll get the actual numbers from Q4 2025. But if you want to do something like this, you can download an app, the GDP Now app from the Atlanta Fed, and they try to update what they think GDP is in real time. So what I'm showing here is this is 0. If the gross domestic product, if the GDP is actually below 0, it means the economy is shrinking, right? Generally speaking, if you have 2 shrinking quarters in a row, maybe we'll call that a recession, right? The economy shrinking, right? If the economy is growing, meaning it's growing more than 0%, then it's expanding. And we're trying to track that. So this was really important, I think, last year, the year before, because there are a lot of people who feel like we're in recession, right? If I feel like I'm in recession, or if I feel like we are in recession, I might be afraid to invest in the stock market. Vibe session, yeah, that's where the vibe session comes in, right? I feel bad, and so we must be in recession. You kind of have to, again, checking our feelings, like, okay, are there numbers that support that, right? Or is it just my feeling? Because we can't just go on our gut feeling most of the time, right? So here, like during 2022, this was like a big, like during that, the market was falling, right? The stock market fell, inflation went up, but the economy did not go into recession. And so when inflation stopped falling, people were convinced we were in recession and were not investing, right? So we just kind of want to keep an eye on these things. And as of now, the economy is still growing. That's good for the stock market. Yeah. There are a bunch of statistics about like flows in and out of things. So you can kind of gauge people putting money into money market funds, which is perfectly safe, right? So if you have a lot of money flowing into money market funds, that's where people are hiding. right? Or if people are putting money into bonds, things that are more conservative, you can see that. Maybe not in real time, but pretty quickly. If money is flowing into stocks, then people are feeling risk tolerant, right? Or crypto as one, right? Like crypto has now kind of become like risk on, risk off gauge, which is interesting. I don't think that's what it was intended to, but it's kind of what it's become. We already kind of went through this slide. Again, I think it's the most important slide in the deck, which is if companies continue to generate profits in the future, then we expect prices to go up. Companies report lower profits usually during recessions, right? So the economy slows down, people get laid off. People now don't have enough money to spend at Target or Walmart or HEB. So now the revenue of that business has gone down. Now they don't have enough money to pay their employees, so they lay people off. And maybe they report lower earnings because they didn't lay people off fast enough. So this is what the business cycle is. Like a natural cycle. But bear markets, so downturns, they're not perfectly coincident, but for a person, the worst case scenario is stock market is down, you lose your job, right? So when we are investing, this comes back to like the long-term money, right? From a personal finance perspective, like financial planning perspective, this is what an emergency fund is for, that we don't get caught in that trap. Like it is a horrible trap to be caught in, right? Oh shoot, I lost my job. I was really aggressive and I put all my money in my 401k and now my 401k is down 20%. And now I need to pull money out of at 20% down, right? So long-term money, because we have to be able to ride out these inevitable waves in the business cycle, the economic cycle, the interest rate cycle, all of these cycles, right? And we don't really know when they're going to happen. These are estimates for earnings. So we will very soon find out what actual earnings were for 2025, and that will become a line. That's going to be very close to what they are. And then earnings for 2026 are expected to be $310 per share on S&P 500 companies. If there is a recession, then all of these people are wrong, and maybe that box ends up down here, right? And then you would expect prices to follow. But, I mean, so we can see it, you can see a trend line, but you see the variability around the trend line. This again is coming back to, we don't have to guess what earnings are in 2026 or 2027 if we're investing for 2030 or 2035 or 2040, right? Just kind of like extrapolate that thing out into the future and don't worry about the annual or dips and increases. But if I was making the bullish case for 2026, it would be that little gold box up in the upper right-hand corner. Again, like this idea of valuations, if we take that PE ratio and then we multiply it by how fast companies' earnings are growing, we come up with something called the PEG ratio. This is just for the S&P 500. So remember the squiggly chart with the red line? And it showed like elevated PE ratios on the red line. And we might be like, oh, we don't want to pay 22 times earnings. This is saying like, well, if you adjust that and take into account that these earnings are growing really fast, then maybe they aren't as expensive as they seem on the face of it. So it's taking the price, comparing it to earnings, and then going one level deeper and comparing it to earnings growth in the future to give us an idea of, are these cheap, are they fair, or are they expensive? Right. So if that E might be way bigger in 2026 than you're adjusting for in your head. So it's just a way to think about. Remember, finance, investing, stock market is forward looking. So a lot of these ratios are looking at past data. We're trying to think into the future. If something comes along and disrupts those huge earnings, especially the Mag 7 put out, then these would be wrong, right? That could the E go down or not go up as fast as people expect? That is where you get drawdowns in the market. Like companies don't meet expectations. We all have very, very high expectations, right? So if they don't meet the high expectations, then the price would come down. Does that all kind of make sense? The AI-driven bull market. So I usually really don't like these types of like comparisons, but I still thought it was interesting and put it up there anyway. Again, if I'm making the bull market case. So here, the purple line is when Netscape was released in 1994, right? Down here, this is the number of trading days since that, since that technology was released. So we're looking at Netscape in 1994 versus ChatGPT being released November 30th, 2022. So kind of this idea of bubbles being built, like it usually takes a minute for a bubble to really be blown, right? So maybe by the end here, you can kind of see there's like this trend line. And then do you see how it kind of like, whoop, like at the very end, it kind of makes an exponential leap while people are really, really getting over their skis out there, right? So if we kind of use the same analogy, it's like, well, it hasn't happened yet, right? Maybe. And so like, again, bull markets can go farther than you think. Like that point of reaching like the bubble stage usually takes longer than you think. So again, this is my bull market case. Right, it was so early, right? Is being early the same as being wrong, right? You sat out the rest of, if Alan Greenspan is talking about irrational exuberance here, and then you got out of the market, you missed the rest of the run up. That's what makes this like so challenging, right? Like maybe it's a baby bubble, right? On its way to being a huge bubble that ruins all of our lives, right? But maybe it's not there yet. That's why this is so fun, you guys, right? We talked about like on the bearish case, inflation getting stuck. This is like the same chart, right? I don't know, like, is this like inflation story bullish or bearish? And the argument can be made either way. If inflation continues to come down, that is definitely bullish for the market. This one, you really have to squint to think that it's still coming down, but you can kind of squint and see that it's still coming down there at the tail end, right? Then I just think this is super fascinating. The secret weaponing fueling growth is seniors with money to spend. Who has all the money? Baby boomers, right? Not literally all of it, just a whole bunch of it. So here we have like the different generations. We have millennials, or this poor little purple slab up here. We have Gen X. I am young, like the youngest Gen X before my elder millennials come behind me. So Gen X is this blue. Baby boomers are this big blue, like dark blue swath. So this is household net worth by generations. And then the silent generation, they're going to be trending downward because they're not going to live forever, right? So that's getting smaller. So when you think about like how wealth is passed down or how wealth is accumulated or who has the wealth or what that wealth looks like, right? It's kind of interesting to think about like, okay, if you have a huge number of people who have paid for houses, right? Maybe one, maybe two, maybe more, right? Paid for. A bunch of, there have been numerous stock bull markets. So full 401ks, right? Rollover IRAs, lots of big brokerage accounts, and are retired and are done working and are out spending money, right? Right. And maybe there's pensions. Maybe the windfall elimination provision was just rescinded, right? So like there's just like for a wide swath of people, not literally all, we're looking in the aggregate, there's a lot of money there waiting to be spent, right? How long can that keep an economy going? I don't know, maybe a long time. Another thing that usually surprises people is that households like actually have a relatively low debt as a percentage of their income. Most people assume that everyone in the aggregate has too much debt. but it's actually not the case. People spent a lot of those COVID checks to pay down their debt, which is very responsible, right? So here, this is showing that household debt service payments as a percentage of disposable personal income. So about 11.2% of people's disposable income goes to debt payments. That's not an overwhelming amount. We can see how much higher it was back here leading up to the financial crisis, right? People really accumulated some debt there for a minute, and that all ended in tears. So that was bad. But so this is like, okay, like in the aggregate, people are not being crushed under debt if we look at it as a whole. Vehicle sales is something to keep an eye on. Like people, when people are really strapped and they don't have any money and they don't have jobs, they stop buying cars, right? So we're still like, okay, here, vehicle sales. So now if we come back, just really quick, we'll have a little bit of time for questions, I think, but hopefully I can get this to run one more poll, you guys. So after this, I want to see if anyone has changed their mind, right? One way or the other. We had a few people who thought it was going to be great. We had no one who thought it was going to be terrible. Most of us kind of shook out in the, it'll be fine, right? After this was a stronger case made one way or the other, where we've kind of changed our mind about what we think is going to happen. Where are my bad people? There are a few coming in now. All right. So a few people were not convinced by the bullish case. I mean, I think this is like so far shaping up to be relative. I feel like there's a few more goods than there were in the first one, right? I mean, I hope that like as we go through, thank you everybody again for doing this. All right, we had a little bit of movement there, I think. I think we had a few people kind of bump up to good from fine. And maybe, I think we lost a couple of the bad people who thought it was gonna be bad. I mean, so like if we zoom way out, right? Like we're talking about 2026 because you guys are gonna be making decisions about your money in 2026. So we kind of zoomed way in on 2026, but really like what we always harp on is being long-term investors, right? So I love this chart because this shows all of these different crises that have happened. This goes back to 1957, right? So we've got Cuban Missile Crisis in there. We've got all sorts of stuff in here, right? All different wars, different outbreaks. Oh, the irrational exuberance is on here. Alan Greenspan, and there's a rational exuberance comment here. It's right here, it's on there, right? We've got coronavirus on there now. We've got like all of these things that can really like the headlines spook people, right? And people get scared and you think like there's no way that the stock market or the economy can absorb this thing that is happening. This time is different. This is so bad, like it'll never recover, right? But if we look back, like the stock market is a reflection of, in the US, we're full capitalism, right? And so we're incentivized to have people go out, create companies or change their own companies to generate as much profit for themselves as possible, right? That's reflected in the stock market. So when the rules change or when circumstances change, the system is actually very flexible, right? Companies change the way they do business. The economy changes. What types of companies do we have in the economy? What grows, what dies? That all happens kind of like a living organism. Some things get put aside, some companies fail, but out of that, some companies are invented, some companies grow, right? And it might take a while for that to happen, but if we expect in the US that to be the future going forward, we would expect the future to look something similar to this, which is really bad things happen, right? And then we adjust and we adapt and we move forward, right? It might take a while. It doesn't happen instantaneously, and it's very painful. And if you're a stock investor, you really want to make sure that you don't need the money here, right? This is where like your personal financial plan comes in. But over the long run, just this idea, like we live in a very dynamic, flexible system that is super complex, and you can't really take a headline and understand how it's going to impact the stock market, the economy. Like the system's too complex. Does that make sense? Any questions about this? I mean, so kind of going back to like, how does it recover? Like the answer is like secretly like, I don't know. It just does, right? Like it's weird. Yeah. This one? Yeah, so this is the dot-com bubble. Yeah, so this is the bubble, and then it had started deflating it had already started coming down by the time September 11th happened, right? So this is a bubble bursting. Like 2000-ish. Yeah, yeah. Yeah, so CAGR stands for compound annual growth rate. So if we put a trend line and we start at the beginning and get to the end, the trend line is 7% growth. And then you add 2.5 or 3% in dividends, which we didn't talk about here, dividends on top of that. And that's how you get to a 10% average annual rate of return. But you're never on the dashed line, right? It's not, this is nice and smooth, right? But the actual is bonkers. So that is, again, like that is to be expected. You don't actually get like 7% every year, 10% every year, right? You get 25% or down 25% from year to year. We get compensated for this higher volatility and this uncertainty through the higher rate of return. Would you rather have a steady, nearly guaranteed 3.5% rate of return, where you are not going to lose any money in your CD ladder? Or would you rather have a 10% annual rate of return with a lot of volatility? Sometimes the answer is made for you, because most of us, like the trap to not fall in is to be a very conservative investor and not have a ton of money. Like the most, I don't know, disappointing piece of financial planning and investing is that the people with the most money can afford to take the least amount of risk if they want to, because they already have enough money. How much would you need to live off of the interest at 3.5%, right? For most people, it's millions and millions of dollars, right? If I have, just to make the math easy, if I have $10 million and my budget is $350,000 a year, then that math works to be really, really conservative, right? But most of us are not there. Our nest eggs, we can't live off the interest. We don't have enough, right? And so how do we get to enough? Most of us need some of our money to be growing at 10% per year over the long run, right? So that is like another, like we control what we are invested in. And this is how great amounts of wealth are created. Great amounts of wealth are not created in your money market, right? That serves its purpose. It is safe. You might need it, but it is not going to make you wealthy unless you already have $10 million, right? I'm guessing you wouldn't be here. If you don't like stocks, what are the alternatives? I'm going to jam through these pretty quick because I know we're over time. I love this quote. I certainly wouldn't invest in the stock market. I never believed in it. Most people lose money because of emotional difficulty involved. Bernie Madoff said that, right? So Mr. Ponzi scheme. So this is an old chart, but it's showing the green line is the S&P 500. The yellow line is gold. Gold has been great this year, right? Short term, awesome, right? Long term, not as good as stocks, right? I have some charts for gold, for you gold lovers out there. Okay, so, why are these colors so close? Sorry. Blue line is gold. Green line is the NASDAQ. So like our tech heavy. So gold has outperformed the NASDAQ over the last 5 years. Pretty crazy. That has not happened in a minute, right? But if we zoom out, last 10 years, NASDAQ has outperformed gold, right? Even with the most recent run up. and then we keep zooming out over the last 20 years, pretty far apart, right? I don't think of gold as a substitute for stocks. So just kind of keep that in mind. If you're like, still not convinced about the stock market, you have to pick something, right? Or just earn more money, right? So that you have enough. It's your choice. Thoughts to take with you. You don't have to know everything. We covered so much stuff here, but just capitalism is flexible. The stock market and companies adapt to change. Stocks have always been long-term wealth generators. So do you need to generate wealth, or are you already wealthy, right? That can maybe determine how involved you need to be here. Short-term predictions are hard. They're nearly impossible. The system's too complex to be predictable. And even if you get a prediction right, the outcome can be wrong. You guys know, first Trump administration, the best performing part of the stock market, like the best performing sector, just guess. First Trump administration. Energy? Isn't that, no, energy was the worst. And tech was the best. What was the best performing sector during the Biden, right, during the Biden administration? Best performing was energy, right? So like you can be like, oh, Trump is bullish for energy, and then they're the worst performers, right? See you guys later. So just kind of keep that in mind too. So if we can't know how the markets are going to react in 2026, what do we do? So Casey's over there ignoring this entire thing. This is where she comes in, because she says investments are part of financial planning, but financial planning is not just investments, right? So now we're getting into like, how do we, commercial, here's me, Casey, right? What can we control? We can set these goals. We can do some planning, put numbers to our idea. What's the nest egg that we're trying to reach? What are our priorities? What are we trying to pay for? We can fund our emergency fund. Again, going back to, you have to make it through the short term to get to the long term, right? Don't crash out with your job and the stock market all at the same time, right? We need something to get us through the hard times. Know your monthly expenses. Oh, I hate budgeting so much, you guys. I never talk about it. I never think about it. But it's super important, right? Where is your money going? How much do you spend? Most people can't tell me, right? But it's like the key thing that goes into a financial plan. It's like how much you spend now determines how much you'll probably spend in retirement and whether you have enough to retire. And then up-to-date estate and insurance planning. So boring, but so important, right? Talk to Casey about that. She always makes me get insurance. And then like if we come back to like this like stock market investing thing, if you're like buying into it even a little bit, the way that most people do it is not, I have $1 million, I'm gonna put it all in the stock market on Monday. It's, I'm contributing to my retirement plan. Do you have a retirement plan at work? Sign up, invest in the stock fund a little bit all the time. Dollar cost averaging, because it means you're just putting a little bit in here, you're putting a little bit in here, you're putting a little bit here, you're buying low, you're buying a little bit here, right? So you're participating in all of the ups and downs. But dollar cost averaging is the way most people do this. They're not making like a decision every day or every year even as to what they're investing in. They're setting it and forgetting it and then checking in on it every once in a while, maybe, right? So this is how most people do it, dollar cost averaging. You know, whatever's happening, you're like, oh, just gonna keep holding. Like Warren Buffett said, right? We'd hold things forever. And then when you need the money in retirement, that's when you come back and see how much you have, right? And we expect the stock market to double every 7 to 12 or 7 to 10 years. So if I have $1,000, I would expect in 7 to 10 years for that to be 2,000. If I have $1 million, I would expect to be 2 million in 7 to 10 years. That's very easy mental math to do, right? How? I don't know. It just does. Yeah. Could be. Yeah. I mean, what's the Dow at? I mean, if I don't have doing the what year were you talking about? Yeah, we're closing in on 50,000 on the Dow. Yeah. So like 15 to 30 to 60. So 90s. How long has it been since the 90s? 30 years? 12, 24, 48. Yeah. I'm bad at math too. I'm sorry. I always have a calculator. Yeah. But you could go back and say compound annual growth rate of the Dow since this date, and someone will tell you what it is. Yeah. 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 I'm so sorry, you guys. I always have too many charts. There were 59. I went over again. I'm going to send all these out, hopefully. And if you have, I'll leave this up while we're cleaning up. If you have questions that you don't, either we don't have time to get to today or that you want to be private, that's my email address down there. So just put like January AWIG meeting in the subject line, and we'll try to get you the info you need. But thank you everybody for your participation and being here. We'll see you on Valentine's Day, where we'll talk about divorce.